Okay, now we're ready to move on to the income formula and the 5 criteria of value. This is the guts of the way people lay out the numbers on investment real estate deals and the way every professional in the business expects to see the numbers laid out and what they use to understand a deal and its financials and of course to come up with its value. So, the income formula starts out with gross potential rent, which is calculated by just multiplying by 12 all of the monthly rents by each unit type. The next item in the income formula is other income. And the way we reach other income is just parking, laundry, and vending. And that's all added into other income plus gross potential rent equals gross potential income. Sorry. Next, we subtract vacancy, very often 5%, but it depends on your market, to get what's called effective gross income. And then we subtract expenses to get what's called net operating income. To have a general idea of what expenses are going to be on a real estate deal, you want to have a little yellow pad with these things written on it when you go to first meetings so you remember to ask all these questions. But basically you're going to have the property taxes, which of course in the state of California change immediately upon sale. So we always calculate the new taxes by getting the tax rate for the parcel and adding the special assessments on top of that. Next is the insurance cost for the building, and then the utilities, PG&E, water and sewer, garbage, phone and cable if applicable. Next, you'll often have on-site management, which can include a free apartment, it can include salary, utilities, workman's comp, and payroll tax are all parts of the on-site management costs. Next, off-site management, often calculated at 5% of gross, but that's not fixed in stone. And the size of buildings which you have off-site management always varies. Often in the 30 to 40 or 50 units and up range, you're almost always going to have off-site management. Below that, it's really on a deal-by-deal basis. In the state of California, you don't even have to have an on-site manager until you get to 16 units. Next, maintenance and repair, also often pegged at 5% of the gross income. Lenders will sometimes use $275 to $500 per unit per year as a reserve number that's often looked at for maintenance and repair numbers. And finally, the other items, miscellaneous items like accounting, legal, licenses and permits, administrative and office expense, and reserves, which are not always used in brokers' packages. Okay, so we subtract expenses from EGI to get net operating income, and then we subtract debt service by calculating either the 65% LTV or the 1.2 debt service coverage ratio format and check with MCC, your MMCC representative to make sure you've got the right loan amount, the right debt service, and interest rate and amortization term. Subtract that from NOI, and now you've got cash flow. And finally, put in the equity buildup, and you've got total return. That's basically the income formula that you do need to memorize, and you need to look at every deal in terms of these numbers because that's what people who are in the business do. Okay, so here's an example of a typical deal with its gross potential rent plus other income to get to GPI, or gross potential income, less vacancy to get to EGI, or effective gross income, less expenses to get to NOI, less debt service to get to cash flow, plus equity buildup to get to total return. Equity buildup and total return aren't really discussed that much in the valuation process because it's not really cash in your pocket unless you refinance or if you sell the property. But it's still an important part of the income formula. Now, here's a typical example of one of our listings and how the information translates into the income formula. We started out in our marketing package with each unit, and you can see the number of units and their rents and the total income for those 3 one-bedrooms, and then the total income for these 21 one-bedrooms and 16 two-bedrooms and the 16 other two-bedrooms. Add it all up, you get the monthly income, which is multiplied by 12 to get our gross potential rent. We've got other income there added to that to get to gross potential income. They're using a 3% vacancy factor on this building, subtracted that to get to their EGI, and using expenses of $306,000 to get to their NOI. With $2,275,000 down, the balance borrowed as debt service of $219,000, leaving cash flow of $154,598, and they left out the equity buildup and total return on this particular package. And here's how the expenses broke down on that package. The real estate taxes, and you can see there's a current and pro forma column here. Current taxes does not mean the current owner's taxes. It means what the new buyer is going to be paying day one. So don't get confused about that in the current column. His insurance, his utilities are lumped together. Maintenance salary, repairs and maintenance, employee benefits is workman's comp and payroll tax, on-site manager, management fee is the off-site management fee, general administrative, and this one does have replacement reserves for total expenses. So they subtract that to get to the NOI. Now that's the income formula, and you basically have to memorize it and use it. Now let's discuss the 5 criteria of value that people use in comparing the sale of one building to another in apartment building business. First one is the relationship of the gross potential income to the price. It's called GIM, and the formula is price divided by gross potential income. But you'll hear everybody in the business call it GRM. Only appraisers typically will say GIM. So when you hear people say GRM, what they're really talking about is the gross potential income, not just the rent. Next, cost per unit, which is nothing more than the price divided by the number of units. Cost per rentable square foot, which is the price divided by the total rentable square footage. And next, cap rate. Cap rate is a measure of return based on the purchase price. It's achieved by dividing the NOI by the price, and the answer is a percentage return. So if you have $100,000 NOI and $1 million price, that would be a 10% return or a 10 cap rate. Cash flow is just the cash flow on the building divided by the down payment. So if you have $25,000 in cash flow and a $250,000 down payment, that would be a 10% cash on cash. That very simply is the 5 criteria of value, and since we use the sales comparable approach as well as the income capitalization approach, obviously this is very important for you to memorize. And this is what it will look like in one of our typical packages. All right, now let's talk about the income formula and the 5 criteria value for leased investments. Almost the same thing, but there's a little difference. When a tenant in a shopping center may be paying $10,000 a month in rent to the landlord, unlike an apartment building, they may also be paying their pro rata share of all or part of the expenses. In other words, if they are 10% of the shopping center, they may be paying 10% of the property taxes, 10% of the insurance, 10% of the maintenance, often called common area maintenance, that includes everything, as well as paying their utilities. This is how the term triple net came about, that $10,000 in rent is net to the landlord of taxes, net to the landlord of insurance, and net to the landlord of maintenance. So the landlord is getting that $10,000 without having to pay any expenses. That's the big difference. This is often called reimbursements, and what the tenants are reimbursing the landlord for in their expenses. So let's take a look at how the income formula lays out in relation to that in a leased investment, which could be a shopping center, an office building, an industrial building, or a single-tenant retail property. The first, the way the income side of the income formula is laid out, we first put occupied space and what the rent is there, and then we put in the vacant space at market rent, and we add to that the annual reimbursements for all of the tenants in the shopping center to get our gross potential income in the property. From there, the income formula is just like the other income formula. You subtract vacancy to get EGI, you subtract expenses to get NOI, you subtract debt service to get cash flow, you add equity build-up to get total return. So in that way, it's similar, but you've got to calculate and figure out reimbursements, and you've got to figure out market rent if you've got vacant space in there. Understanding where the income comes from in a leased investment involves reading the leases and knowing and understanding who the tenant is, what their square footage is, what their rent is, what their lease commencement and termination is, whether there are escalations in their rent, and when, and how much, and for each lease and each tenant, what expenses do they pay, what percentages. Finally, do they have options, how many options, and how long do those options last, and what are the terms of those options if they do have options. So this again is what the income formula looks like in a leased investment. And the 3 criteria value we use in leased investment are cost per rentable square foot, cap rate, and cash flow. It's distinguished a little bit from apartment buildings. Well, that's the basic analysis of how we lay out the income and expenses of a building on the financial side to begin to understand how much it's worth.